we're going. Okay, we want to thank you for the third week of this fall's Maxine Pierce Executive Speaker Series. Before we get going, I want to first off thank Maxine Pierce. Without speakers like her, we would not be able to do fun educational events like this, and we just want to thank her because we very much appreciate that. And I also want to give a thanks to Dean Pete Sherman. He always figures out how we can get things done if it's for the good of our students, helping them engage more, learn more, get internships, whatever. And I come to him all the time asking to do things, and he will always work with me to make things happen. So we want to really thank him. Next week, before we get going this week, we want to let you know that Jerome Main, he is an author of The Diary of a White Collar Criminal. He will be talking on fraud and ethics. In this, via Zoom, you can come back to the room. I'll have pizza. If you want different types of pizza, just let me know. I'll get whatever you guys want. So it'll be a great talk, and we're excited about that. So for this week, I want to introduce to you Dave Plant. He is one of our economics professors. He is here. He's been working with me on this topic. And Dave has a BA from Boston University and a PhD from the University of Utah. He has been at Western since 1997.
Forever.
Forever. That is forever. He teaches macro economics, international economics and globalization, money, banking, and financial markets, American capitalism and democracy, poverty and world development, economic development, and sustainability. So we are just really excited to have him. I did want to set a quote from Dave that is on our website that they asked him, what excites you most about this field? And I thought it was super relevant for today. Economics taught well simply provides a framework and approach that makes the world more comprehensible. From financial crisis to pharmaceutical crisis, to inequality, to famine, to development, the discipline can help make sense of existing relationships and provide possible paths for improvement. I just couldn't think of just a better quote for today, because we're really excited to have Ashley Burt. Tyler Hannah is here. He is my student intern, and he is helping me with the event. He is the coordinator of the event, and he is going to introduce Ashley. So thank you so much for coming.
Hi, everyone. Thanks for coming again. It's going to be a lot of fun today, I hope, in digging in, talking about relevant topics and everything else. Ashley Burt graduated from Western Colorado University with a Bachelor of Science in Business Administration, Managing, and Accounting degree. And Ashley was born in London and moved to Colorado to be a ski bum, but failed at that and became a bank president. And he is president and CEO of Gunnison Bank and Trust. And Ashley also serves on the board of directors for the Kansas City Federal Reserve Denver branch. So thank you, Ashley, for being here and being able to, hopefully teach all of us something that we can take out of here today.
I will do my best. So one correction on the bio. I actually graduated from Western State College. Maybe you guys have heard of that.
University.
I won't start. Thanks very much for having me. It's great to be here. Here, of course, is the office nook in my bedroom, but whatever, new normal. This is how we do stuff now. As mentioned, I am a Western alumni, and I certainly loved my years there. I lived full-time in Gunnison from 1988 until 2016, and in 2016, we expanded the Gunnison Bank to Denver. And so I started splitting my time at that point at Gunnison and Denver, and I still do that today. It's a nice existence because I like them both. Now, Dave is an economist. I am not an economist. I'm a banker. Now, I'm often surrounded by economists, sometimes hundreds of economists, but I'm a banker. Economists always have all the answers. You heard Dave's quote earlier. That's indicative. Economists have all the answers, bankers don't. But I do serve on the Kansas City Fed Denver Branch Board of Directors as a banker. And as such, I'm a Class A director on that board. And what that means is I'm voted in by other 10th District Federal Reserve member banks into that position. So today I'm going to give you an explanation of the Fed's structure. And the reason is because it's critical to understand some of the details that have made this institution what it is. You've got to understand where it came from and how it's structured today. Then I'm going to give you an anecdote from the 2008 recession for the purpose of comparison. And, you know, that recession was yesterday to me, but I realized that some of you were probably in 6th grade. And, you know, as such, you may not have followed it very closely as it was unfolding. So the first try at a central bank, a Federal Reserve Bank here in the U.S., was spearheaded by Alexander Hamilton in 1791. Some of you theater folks may know some songs about it even, but that lasted about 20 years. And the reason it fell apart is mostly rooted in public distrust. Folks didn't understand and didn't trust it. So there was a second try in 1817. And once again, this did not become permanent, and it closed in 1841. Again, reasons being public distrust and being misunderstood. So the Federal Reserve Act of 1913 is what authorizes the current Fed. And just as an aside, Gunnison Bank and Trust was 3 years old in 1913, having been chartered in 1910. So Gunnison Bank and Trust is slightly older than the current version of the Federal Reserve. But what makes the current version of the Fed distinct is that it's decentralized and it's a public-private structure. And the purpose of structuring the Fed like that was to say, okay, how can we try to remove some of the dynamics that undid us the last few times? Perhaps with a public-private venture together and a decentralized structure, there wouldn't be quite as much criticism. It might be better understood, and it might therefore be more durable. So today, the Fed operates under that structure, and they operate under two mandates from Congress. It's called our dual mandate. So the first mandate is price stability. And you hear about that in the news, more often referred to as inflation. We either seem to have inflation or we don't have inflation. But price stability is important for long-term planning and for getting the economies to work well over long periods of time. So price stability is the first mandate. The second one is full employment. And the Fed uses 6 different measures of employment, but uses those measures to try to keep employment at what is considered a low but long-term sustainable rate. So, but as part of the independence of this version of the Fed, today's version of the Fed, the tools that the Fed uses to achieve these two mandates are not mandated by Congress or by anybody else. So the Fed gets to be this sort of independent think tank of coming up with new ways in which to correct macroeconomic policy and the economy as a whole. I'll give you a couple of brief examples. Interest rates is the one that always gets the press. Interest rates are set by the Fed, both to stimulate economic activity and also at times to artificially inflate the value of interest rate sensitive assets, because both of those two things can be really important tools. The tools used to manipulate interest rates have changed over time. It used to be done almost entirely through liquidity, and this just uses basic supply and demand. When the U.S. economy was running hot and the Fed wanted to increase the cost of money, all they had to do was reduce the supply. So the way they used to reduce the supply was they would increase the reserve requirements that all the Fed member banks had. That would pull money out of the system. Money becomes more scarce, and like anything, it becomes more expensive. So there was this liquidity component to setting interest rates. Well, in 2008, one of the things we learned in the Fed is that didn't work anymore. And the reason it didn't work anymore wasn't because things had necessarily fundamentally changed, but it didn't work anymore because the economy had grown so large. The economy today is about 21 trillion, and that is approximately double what it was in the year 2000. So the problem became, even though the Fed could pull liquidity back out of the system, it simply wasn't enough for an economy of that size to really make an appreciable difference in the value of that money. So the Fed invented a new tool in 2009 or 10, and it's called the Fed Excess Balance Account. And it's the first time the Fed became an actual payer of interest into a space like this. They actually started paying interest to banks overnight on their excess liquidity. By doing so, we're able to set market rates wherever needed. What you'll notice if you start diving into that is the only rate that they can control with these tools is the overnight rate. Really, really short-term money. So it's where Gunnison Bank and Trust parks its excess liquidity overnight, or we're making more loans than deposit at any given time, and maybe where we borrow liquidity overnight. But what the Fed has always had a bit more trouble doing is controlling rates further out down the yield curve. So if you think about the yield curve, and I know it's a very diverse audience, so I'll try to just touch on these topics, but not in too much detail. And you can just yell at me if it's too much. The yield curve is essentially a graph that tells you the value of money over time. And under normal circumstances, the longer the time period, the higher the interest rate paid on that money. Quick example, if you borrowed $100 for a year, you might pay one rate. If you borrowed $100 for 10 years, you would expect to pay a higher rate. That is usually the case. It is not currently the case today, but lots of things aren't normal today. So the Fed had to come up with different tools for trying to move the end of the yield curve. Mortgages are priced out for 10 years. When people look at mortgage rates, it's important that they know where that comes from. It comes from the 10-year 10-year Treasury, and that's a piece that's tough for the Fed to manipulate. So the Fed did something that I'm sure you've all heard of, quantitative easing, and the purpose of that was to essentially create artificial demand for an asset and thereby increase its price. We'll come back to those specifics, but I'm going to tell you my favorite story about monkeys and artificial asset value. I think this little story really nails. Well, I'll tell you the story, and you can tell me what it is. Once upon a time, in a place overrun with monkeys, a man appeared and announced to the villagers he would buy monkeys for $10 each. The villagers, seeing that there were many monkeys around, went out to the forest and started catching them. The man bought thousands at $10, and as supply started to diminish, they became harder to catch. So the villagers stopped their efforts. Then the man announced he would now pay $20 for each monkey. This renewed the efforts of the villagers, and they started catching monkeys again. Soon the supply diminished even further, and they were even harder to catch. So people started going back to their farms and forgot about monkey catching. The man increased his price then to $25 each, and the supply of monkeys became so sparse that it was an effort to even see a monkey, let alone catch one. The man then announced he would buy monkeys for $50. However, since he had to go to the city on some business, his assistant would buy on his behalf. While the man was away, the assistant told the villagers, "Look at all these monkeys in the big cage the man has bought. I will sell them to you at $35 each. And when the man returns from the city, you can sell them to him for $50 each." The villagers rounded up all their savings and bought all the monkeys. They never saw the man nor his assistant again, and once again there were monkeys everywhere. So that's quantitative easing in a nutshell. The Fed went out and actually purchased all sorts of mortgage-backed securities that were coming into a market that didn't really want them because there was so much uncertainty. So by creating a market for these mortgage-backed securities, the Fed was able to increase demand, reduce supply, and thereby raise the effective rate out of the 10-year point on the yield curve. So the point is, these tools evolve, they become new ideas. We sit around in meetings and talk about ideas, ways to affect the macroeconomy. So let's talk a little bit about the Fed structure. So I mentioned already decentralized public-private structure, and it was structured that way to combat prior issues. But what does that mean? So The Federal Reserve system of 12 banks are really built to be insulated from political pressure. It's important because politics and monetary policy should be separate. Let me say that again. Politics and monetary policy should be completely separate. So part of the structure of the Fed is that no political approval is required for operations. In addition to that, the Fed is entirely self-financed.
Yes.
There are no congressional appropriations. Can you guys still hear me?
Yeah.
Yes.
So the Fed is self-financed, and there are no congressional appropriations required. And you can imagine the kind of pressure Congress could potentially put on the Fed if Congress had to approve the Fed's budget. So that tie has been severed, no congressional appropriations. Now, of course, Congress could change the rules. So the way we refer to it today is we say the Fed is independent within the government. So under the current set of rules, no approval for operations, no appropriations, fully independent body, but we always recognize that, that's not carved in stone. That's the way it is today. I want to touch on audit the Fed because I get asked about this a lot. As a part of going to the Kansas City Federal Reserve meetings, I attend the audit committee meetings. In a typical year, the Kansas City Fed is audited 42 times, or about once every 6 days. The audits vary, and they're in different departments and looking for different things, but they're done. Some of them are done internally, but most of them are done externally by a very highly respected set of outside auditors. The current one is KPMG, which is a large accounting firm. So it raises the question: what is Rand Paul getting at when he cries audit the Fed? And I think it's important to call it out for what it is. It's not what it sounds like. Essentially, what Rand Paul wants to do when he says audit the Fed is he wants to make monetary policy subject to congressional oversight. And I really can't think of a worse idea than that. I mean, not only does Congress have trouble getting anything done, the political pressure that could potentially be applied in a situation like that is a very scary thought. So let's move on to some specific pieces of the Fed, because there are these three sort of main pieces that make up this public-private partnership. So the first one I'll touch on is the government piece, and it is centralized, and it's called the Board of Governors. These guys are in Washington, D.C. When you hear about Fed statements, it's usually something that came out of the Board of Governors rather than one of the bank boards. These folks are individually appointed by the president, and they do require a Senate confirmation, and so that inherently makes those positions political positions. So this is where some of the government and some of the politics do come into the Fed. They are appointed to 14-year terms, and the purpose of that is so that they serve multiple administrations, and that they hopefully get to avoid some political pressure by doing so. Then if we move to the next level of the Fed, it's the regional banks, and there are 12 of them, each serving a different district. And these are run just like private banks. The boards do not require political approval. The directors come in three classes, A, B, and C. Class A are bankers, and they're elected by member banks in the region. That's the type of director I am, a Class A director. Class B are members of the public, and they're also elected by member banks in the region. And then Class C are members of the business community from pretty well any walk, and those folks are Board of Governors appointed. And it's interesting to note that the chairman of the bank boards and the vice chair of the bank boards have to come from Class C directors, so they have to come from folks involved in industry who are then appointed by the Board of Governors. So you can see, and I'm about to give you one more layer, but you can see already sort of the cross threads of biases and politics versus private and government versus private that this structure is attempting to build. So, still under the privately run 12 regional banks, the president of those banks, each one has a president, is voted in by the board of directors of that bank and also does not require political approval. And then the capital to run these banks actually comes from all the Federal Reserve member banks within that district. So Gunnison Bank and Trust is a member of the Kansas City Fed. We have reserve requirements, which means we have to keep a certain amount of money at the Kansas City Fed. And that chunk of money, along with all the other banks that are members of the Kansas City Fed, make up the capital base for that Federal Reserve Bank. So then the third layer of the Fed is a mixture between the two that I've already laid out, and that's the Federal Open Market Committee. The Federal Open Market Committee is the hands-on operational component of setting interest rates and setting monetary policy. So there are 12 members on the Federal Open Market Committee, and 7 of them are the Board of Governors, and then 5 are bank presidents from the 12 regional banks. Now, New York gets a permanent seat, the New York Fed. It's a whole separate talk as to why New York gets its own seat, but anyway, New York gets a permanent one, and then the other 11 Federal Reserve presidents rotate through the other 4 seats. Now, it's important to note that every one of the Federal Open Market Committee meetings is attended by all the bank presidents. They all get to present, they all get to discuss, they all get to make their case for whatever they believe should take place, but that then only 5 of the bank presidents get to vote. So some of the 12 banks have branches, and Denver is a branch of the Kansas City Fed. Branches meet independently. Branch directors also participate, though, in the Kansas City Fed meetings on a rotating basis. When we're in there, we discuss economic conditions. We get really good data from Fed economists. This is one of the times I often feel surrounded by economists. And then we discuss and we vote on monetary policy. Our votes at that level are non-binding, but we add a lot of commentary and we make a case, and we make it for the Kansas City Fed president, Esther George, who's in our meetings, and she takes our arguments, our data, and our votes with her to the Federal Open Market Committee. Now, we get tons of really good data in these meetings, some of the best reports. Some of this stuff is just a day or two old. But part of the reason directors are encouraged to discuss and defend and provide anecdotal information is the concept of grassroots economic information that the Fed holds so dear. Essentially, every report we get and everything we get from the economists is all looking backwards. It's all historical. And what the Fed really needs to know is what's going to happen in the future. And so one of the things they've determined is by getting on the ground anecdotes and information from specific directors, they can really get a more forward-looking picture about what might be what might be coming down the pike. For example, one of the things I will always report on is the demand for construction loans next spring in the Gunnison Valley. I mean, I know what that is already. They're already applying. They're working on architectural plans. Well, that doesn't appear in any economic report anywhere in the world, except the report that I give at the Federal Reserve directly to Esther George, talking about future loan demand for a product that drives a big chunk of the economy and a really big chunk of the Gunnison Valley's economy. So the Gunnison Valley is included in every Kansas City Fed meeting in that respect. Okay, so that's a lot of info, and I can't really see you guys, so I can't tell who's falling asleep or what else might be going on. At this point, I guess I just ask if there are any questions on the basic structure of the Fed and kind of what I covered so far, and then after that, I'll jump back in and give you a little blurb on our core question, some information on the 2008 recession, and then we'll open up the floor to full questions after that. So. I'm not sure, Louise, what the protocol is here, and if you can see in chat if there happen to be any questions on really the structure.
Have you got any questions on the basic structure of it?
I've always been intrigued where you've got a situation where you got 12 Federal Reserve banks, and only 5 of the presidents vote, 7 Board of Governors. You've always got a majority. And not only that, you got 12 Federal Reserve banks, only 1 in the western half of the United States. I know you've got branch banks all over the place, but that also means that you still have 7 Board of Governors as a majority, even on the FOMC. So I thought that's kind of interesting.
Yeah, depending on how you phrase that, you could phrase that as a strength or a weakness. There's given how old the Federal Reserve is, there is some East Coast bias, but you know that's more or less the direction this country expanded from. So I think today it's an inherent piece of some of the bias in the Fed, but as you can see from the structure, there's a fair amount of thought put into at least attempting to cancel out some of these biases with cross currents.
Anybody else have any questions? Structure? Okay, we'll go into your next section.
Oh, there's one.
There's one on the bottom. I'm going to read it.
Okay.
I'll read it. It says, how does the Kansas City Bank take the Come on.
How does the Kansas City Bank take the information for large cities? And is there a director to represent the cities and one for a region of smaller towns?
So the short answer is there is most of the time, but there isn't a specified structure to protect that. So as the Fed is looking at either appointing new directors or encouraging folks to accept nominations to be voted into those seats, they do try to take that kind of stuff into consideration and say, okay, what representation do we have, say, from the western slope of Colorado? And I often get sort of tagged as that one, western slope of Colorado. Okay, we kind of have that area covered. What else within the 10th district? If you're talking about northern New Mexico, do we have someone from Albuquerque? Do we have someone from Wyoming? Making sure that the bases are covered within the 10th district. So I guess in an informal way that is addressed, but there isn't a specific structural piece for it.
Awesome. Anybody else? Structural stuff? Okay, well, we'll go on to your next section, Ashley.
Okay, so let's talk about 2008 a little bit. And if you were
By the way, the principal students are actually going to write their second paper on comparing the 2008 crisis to the current pandemic. And both the principal students and the money and banking students are doing presentations on Friday on the 2008 crisis. So they're going to be listening very closely to what you have to say.
Okay, and I'd like copies of the papers because I need to know too.
Okay.
We can get that.
Okay. Okay, so how does the current recession differ from the 2008 recession? And the short answer is in every single way, it's different. So let's start. I want to tell you guys a story about one of the many disasters from 2008. And I'll preface this by saying this is not the root cause of the 2008 recession, but it's indicative of many of the root causes, and it'll help us understand the differences because this type of stuff did not happen as a prelude to our current recession. So we're going to talk about Goldman Sachs a little bit. Some people refer to them as Darth Goldman. You may have heard of them. Under the guidance of Hank Paulson, Goldman issued a bunch of mortgage-backed securities. And when they did that, only Goldman really knew what was in these securities because they had handpicked the mortgages that were going to go into this security. Now, as just a technical matter, just a little bit of background on the security for those of you who care. The security I'm about to tell you about is actually a synthetic collateralized debt obligation, or a CDO, and it was made up of about 90 bonds derived from subprime mortgage loans. The name of the security was Abacus 2007-AC1. Sounds harmless, right? But in essence, it was a big pile of mortgages that are thrown into this security. And when you purchase the security, you get a little slice of it. So after Goldman assembles this security, they, as was the norm, they pay the rating agencies to rate the security. And at this point, this security, Abacus, gains a AAA rating from Moody's. And this is really important here, the fact that they were able to get AAA rating.
What do you have to do to get the extra credit? Watch it.
Someone's not mute. Someone mute.
Okay.
Thank you. So Goldman is now paying the rating agencies to rate this security, and they get a AAA rating from Moody's. But the problem is the underlying mortgages were not a paper. They were early tranches, which means early sections, so you can buy years of a mortgage. You don't have to buy the whole thing. But they were early tranches of something the market back then was calling Alt-A, or Alt-A paper. What does Alt-A mean? Well, there wasn't much of a technical description back then, but really, I mean, the way I looked at it was Alt-A meant not A. It doesn't really tell you what it is. It tells you what it's not. You know, was it B paper? Was it C paper? I don't know because it wasn't rated on that basis. But the underlying mortgages were called Alt-A, and the security that they fed was Goldman convinced the rating agencies that it was a top-notch security, that it was even great. But we now know, with the benefit of hindsight, that Goldman ended up holding none of this security itself. It sold every single piece of it. And the Goldman intentionally picked loser mortgages. They knew these mortgages were going to default. They went in and selected them for that purpose. So back to the security. It sells well, right? They sell out of it. Banks put them on their balance sheet. Individuals might have them in their 401ks. Your grandma might own them. Municipalities invested in them. Gunnison could have owned some of Abacus. And so Goldman made a lot of money selling this security, but they are not done making money on this deal yet. At this point, Goldman goes derivative shopping. And they essentially bet against the securities by purchasing something called a credit default swap from an insurance company called AIG. Now, credit default swap is insurance on a security that you would typically purchase if you owned a security. If you were someone who owned a lot of this security, you might say, wow, the yield's good, but I've got a lot of eggs in this basket. I'm a little bit concerned about it. I think I'll buy a credit default swap to insure at least a portion of my holdings so that if something goes tremendously wrong, I'm not going down the tubes. That's really what credit default swap derivatives were all about to begin with. They morphed into something else in the mid-2000s. They morphed into something that was more of a gamble or a bet, something speculative that could be used in very different ways. So Goldman goes and buys these credit default swaps. And that means that if Abacus defaults, AIG has to pay Goldman. But hang on a second here. If you remember, Goldman sold all these. Goldman doesn't own this security any longer. So this is called a naked credit default swap. And what it means is you went out and bought the insurance on a security that you didn't own. And so back to the, what's the purpose of credit default swaps? Well, it was supposed to be for hedging bets. It was supposed to be for insurance. But this became speculative and it became a gamble. And to put it in perspective, I would ask you guys, should I be allowed to buy fire insurance on my neighbor's house? And if I am allowed to buy fire insurance on my neighbor's house, should I hope that it burns down? What if I got to help build my neighbor's house before I bought fire insurance? Should I try to build it with more flammable materials so that it'll burn down really easily before I buy the fire insurance? These are absurd questions, but this is literally the position Goldman found themselves in. Well, not shockingly, Abacus goes completely belly up within a couple of years. All the holders of the Abacus security lose lots of money. And not Goldman because they sold the entire batch of securities under a AAA rating from Moody's, and they sold them to their best customers. And they made money selling them, but not as much as they were about to make. Because now Goldman goes and makes a claim on its insurance from AIG. And it is the single largest insurance claim ever made on planet Earth. AIG can't pay it. AIG can't pay the claim and becomes insolvent. And so under the guidance of Hank Paulson, that name might sound familiar. At this point in the story, Hank Paulson is a U.S. Treasury Secretary. But at the beginning of this story, Hank Paulson was the CEO of Goldman Sachs. So he put this whole plan together. And then by the time it blows up, Hank Paulson, as Treasury Secretary, bails out AIG. Why? So that AIG can pay Goldman on a credit default swap. Think about that for a minute. The whole story was seedy, but the end, the kicker is the unbelievable part. Anyway, so that's not the only issue that caused financial collapse, but it didn't help and it wasn't in isolation. It's emblematic of what was going on in 2008. Related issues were pretending all mortgages were safe investments, allowing rating agencies to be so obviously manipulated, allowing naked positions to credit default swap ownership for securities you don't own. That, by the way, that became legal in the year 2000 under the Financial Modernization Act, and it's still legal today. And then finally, allowing AIG to sell a policy for which it had insufficient reserves. Where was the state insurance commissioner when that was going on? All of this kind of wraps around the core issue of the 2008 recession, which is too big to fail. You couldn't let AIG crash. You couldn't let Goldman crash. There were going to be too many incidents of collateral damage. So the epilogue to that story, it's pretty short. Goldman settled the civil suits for $550 million, while Hank Paulson was paid a bonus of $12 billion. Nice ending, huh? So today, today mortgage underwriting is dramatically different. You could not produce the crap can quality of mortgages that you found in Abacus. Markets won't buy them today. They aren't a part of the flow of mortgages today, but they certainly were in the mid-2000s. So the main point here is that these underlying issues from 2008 were A, financial, and B, about trust. They damaged trust and confidence in financial markets. They damaged liquidity and markets froze up. Short-term asset values went nuts because there was zero market liquidity to allow them to sell. And it rippled through markets, but it took time. This recession slowly got worse over a period of several years. Whereas today, it's a sudden onset. It's all occurred at once. It came out of the blue. Not a lot of folks saw this coming. There were not these underlying financial issues. Markets went in strong. There aren't big financial players to be bailed out today. Most of the Fed economists at the beginning of this expected this to be what they referred to as a supply-side driven recession. In other words, you couldn't get things. Demand was there, but you couldn't find the stuff. Think toilet paper. Right? It was a big deal up front, if you guys remember that. But that got sorted out. The good news is you can get toilet paper again. The bad news is it just shifted to a demand-driven recession, and it hit some very specific industries. Live performances, venues, bars, restaurants, in-person services like haircuts, the travel industry, demand for office space. All those industries have taken a direct beating right now. But liquidity is huge. Banks are more liquid than they have been in a decade. There's stimulus money everywhere. There's an awful lot of what we refer to as fear saving going on. When folks hit uncertainty, they tend to save money. And then you've got spots like the Gunnison Valley that actually had a tremendous summer from an economic perspective. And some businesses are doing great. Zoom grew over 900% in the first quarter. Here we are in Zoom. And they moved into a new building just down the street from me here in Denver. But zero models exist to look at what's going on today. You know, in a traditional recession, we can go back and say, well, you know, this happened in this year and this happened in this year. But for today's recession, there simply aren't any models. And so we don't know today how this is going to ripple through the economy. I will say this, the economists at the Federal Reserve, I told you earlier, economists have an answer for everything, and most of them have an answer for this too. It's a different answer from each economist. So I don't, I don't know what to do with that. So anyway, that's the snapshot of 2008, and I'd open it up to questions now, really on whatever you guys want. You can ask me about the specifics of some of that stuff, or we can go anywhere else.
Go ahead, here, Garrett.
How did that security get a AAA rating?
That's the $1 million question, isn't it? You know, when Dodd-Frank was first being put together, and Dodd-Frank was sort of a legislative answer to what had occurred in the 2008 recession. They were gonna fix everything. One of the early drafts of Dodd-Frank actually had a lot of rating agency controls in it, and had a lot of teeth, really, to get rating agencies to abide by these new controls. But as is often the case, that component of Dodd-Frank was lobbied out early on. And Dodd-Frank ended up becoming, to some degree, a political football that got thrown back and forth about, with this sort of underlying theme that all banks are evil, even small independent banks like Gunnison Bank and Trust in Gunnison, Colorado. I assure you, we didn't behave like that. we actually know all our customers. We see them in the grocery store. But instead, we ended up with lots and lots of legislation surrounding things like ATM fees and NSF fees, other components that really didn't play a role in causing the 2008 recession. So I don't really have an answer for you, because they should have been included. Agency ratings should have been part of the overall solution, but they simply weren't. And so that component of the problem still lurks out there for next time.
Before I ask any of these, does anybody in the room want?
There's one from online.
You want to ask it?
Yeah. This is from Sean Erickson, and he says, how was the Spanish flu, I need to unmute, or can you unmute? How was the Spanish flu pandemic different from today's?
Is this a biology question or a financial question?
Yeah, I think it probably is on the finance of it. So. How was your biology at Western?
That's a really interesting question. It's honestly one I haven't pondered before. I would suggest that perhaps the modern component of interconnectivity, how markets are so well connected now. You know, a fortune can be made or lost in Gunnison depending on what happens in New York tomorrow. So that sort of interconnectivity was not a component back then. And when all commerce was local, probably most of that continued to some degree or another, because there weren't these larger and broader interconnected bigger markets to be damaged. And so, you know, as a more local economy back then, it may have been more resilient to all sorts of forces that something like this can create. From a biological perspective, I will just say that masks worked then, just like they work now.
So my question is, how big of a role did big banks play in 2008 crash? Like, we all know about this Wells Fargo scandal, when they had like really messed up system in Wells Fargo, after which Wells Fargo become little Nazi Germany. Like, from my father's divorce, he works in Wells Fargo investment departments, and he's saying basically after the scandal in 2008, Wells Fargo became like really strict on a lot of rules, especially about mortgages that were the biggest part of scandal in 2008. So how big of a role played the scandals in banks in 2008 crash?
Okay, I couldn't hear the entire question, so let me try and paraphrase it back to you, make sure I get it right. The question was the role of the big bank in the 2008 recession. Is that correct?
Yes.
Okay.
And he mentioned Wells Fargo in particular. So.
Yeah,
right,
especially
right.
Wells Fargo. Like,
Well,
that's the one.
And you know, a lot of the big banks did make some changes, and you haven't read about them in the last 10 years or so. But Wells Fargo, for whatever reason, continues to make headlines with horrible things they've done to their customers. There were 350 fraudulent accounts opened within Wells Fargo by Wells Fargo employees. You're just not hearing that kind of stuff from the other big banks. But back to the first part of the question, the 2008 piece and their role. You know, some of the banks participated in a lot of trading, be it proprietary or otherwise. They were trading their own stuff, they were trading other people's stuff, and so they were hit hard when this whole thing came down. And even a lot of smaller banks who might have rather innocently gone out and purchased something like Abacus to put on their balance sheet, also got hurt as this whole thing rippled downstream. But the biggest issue that came out of the components surrounding your question from 2008 is the concept of too big to fail. And too big to fail still haunts us today. We have not resolved too big to fail. And the basic issue with too big to fail is that these larger banks, and it's typically the top 8 banks, and just to put this in perspective, the top 8 banks in the United States control about 96% of the bankable assets. And the remaining 5,992 banks control the other 6%. Think about that for a second. It's remarkable. But because of that, there is so much interconnectivity with these large banks that if one of them were to go down, it was going to affect so many other people in such negative ways that the fallout might take years and years and years to fix. Some of it will never be fixed. Quick anecdote here. In 2008, in June of 2008, I was lucky enough to have breakfast with Ben Bernanke. He was at the time chairman of the Federal Reserve Board of Governors. And he told me a story about something that happened just 2 months earlier in the Bear Stearns trading floor. Bear Stearns was an investment bank that was essentially a casualty of the 2008 recession. And it was one of the first large, significant institutions to go down. So it caught a lot of attention. Well, it went down on a Friday, and that weekend, some of the Board of Governors and some Treasury officials and others went into the Bear Stearns offices, which were now empty because it had completely folded and sent everybody home on the Friday. Mr. Bernanke told me that as he walked through these offices, they were looking at the stuff on the traders' desks, and there were hundreds of millions of dollars of deals, of swaps, of derivatives, things like credit default swaps and interest rate swaps, written on sticky notes and stuck on monitors. And he had the realization at that point that if they just let this thing land on its face and it's gone, nobody knows how to unwind these transactions. Nobody knows who owes who $100 million. The ensuing decades of litigation and unfairly allocated resources, it was just going to be so overwhelming, we may never have unraveled it. So you compare that with the evil of bailing out the very institutions that had a hand in causing all of this. Now, that doesn't sit well with anyone. I'm sure it doesn't sit well with you guys. It didn't sit well with me at the time. It didn't sit well with anybody running an honest bank, especially smaller and mid-sized banks, who, we all knew we were going to pay like crazy for this problem, but we had absolutely nothing to do. This is my disclaimer. It wasn't us. But that's the concept of too big to fail. You can't just yank an institution with that many connections out of the center of an economy because it won't end well. And it won't end well for so many innocent people who had nothing to do with it. So we still live with that legacy. And there's a lot of discussion about breaking up the 8 biggest banks. We do have some legislative angles on this kind of stuff, but no action has been taken. It's essentially congressional inaction is the reason that too big to fail continues to this day.
So we've had a lot of questions come in from the Zoom people. I want to ask one. This is your question, Lisa, if that's okay. Okay. So Lisa's over there, and she asks, okay, do you think the Fed having negative interest rates would be a good idea? Why or why not? Now, I'm going to add to that, just from a banker view, I think that would be interesting to hear your thoughts on that.
Yeah. So I'll give you the punchline right up front, and then I'll explain why. I don't think it would be a good idea. Most Fed economists don't believe it would be a good idea. And I actually sat through a couple of weeks ago in a Fed board meeting, an hour-long presentation on why negative interest rates aren't a good idea. So let's start with what they're supposed to achieve. If there is not enough economic activity taking place and people are nervous about it, they tend to just save their money. And if they can put it in a savings account and earn 5% on it, they might be quite happy doing so. So when the Fed takes action to lower rates, there are a lot of different reasons, but one of them is to spur investment and spur development. Have people who might be sitting on large sums of money say, okay, I'm not going to earn anything on it here in Gunnison Bank and Trust's crappy little savings account of 0.1%. So I'm going to build an apartment complex, or I'm going to invest in a dog food company, or I'm going to get out there and do something with my capital. So that's one of the reasons that rates get dropped in those situations. So it would seem logical up front, it would appear logical to say, okay, if dropping them to 1% spurs some level of investment, dropping them to 0 might spur an even higher level of investment. What if we made them negative? What if we punished people for putting money into savings account? Wouldn't that drive folks to invest in other stuff and stimulate economic activity? I mean, it seems reasonable, right? But here's the thing. We now have watched Japan, Switzerland, Sweden, the European Central Bank. We've watched other large economies experiment with negative rates for the last decade as they've continued to try to climb out of the 2008 recession. And they really haven't worked. There's several reasons, and some of it is speculative, but there's several reasons why we believe they haven't worked. One is that the Fed and other central banks can mandate negative rates to the banks, but they cannot make the banks pass it on to the consumers. And so what most of the larger regional banks in these economies are doing is just eating the difference. They aren't passing on negative rates to the consumers. The consumers might be getting 0, but they aren't getting negative. The second flaw with it is that it's not a large enough incentive. Most of these economies were doing like 20 basis points of negative. And so it wasn't enough to really change habits, and it wasn't enough to force that to be passed through to consumers. Third was the public outcry from it. How would you guys feel if you were trying to save for something right now, I don't know, grad school or something else? Next semester maybe, who knows what it is. But what if you were saving for something and I told you as your local banker, by the way, we're charging you -1 on your savings account? I mean, it would be tremendous public outcry. So I don't, oh, you know what? I forgot to preface the beginning of this talk by saying all these opinions are mine, not the Fed's. So here's an important place for this. This is mine. I don't believe we're going there. I don't believe the models that we've seen in other countries entice us to. I don't believe the will the Board of Governors is there. I know it's not there from Esther. She's been quite vocal about not wanting to go there. So I do not expect to see it. That said, crazy things happen. Stuff we don't expect does happen. I'll leave it at that.
I think Tyler's got some questions from the Zoomies.
Yep. So this question's from Scott Lazarus, and
He's another one of our economists here.
said, in the current recession, most of the early job losses were temporary layoffs, but now we're seeing this shift toward permanent job loss. It took over a decade to recover the lost jobs from the 2008 recession. Could we be looking at a similar situation now?
That's an excellent question from my colleague.
Yes. Next question.
So,
but we did see what we saw early in this. We saw a couple of things. One is we saw a bit of a panic response, and two, we saw more uncertainty than I can ever remember seeing. Even in the crashes of 2008, we had some vague idea about what was going on. At the beginning of this recession, we really didn't understand what the future held, and I don't mean just next year. I mean, we didn't understand what next week held. So there was a lot of defensive posturing. A lot of that led to layoffs. There were also a lot of mandated shutdowns, which led to zero business. One of my fellow board members runs a global hotel chain. He said they lost in the first couple of weeks of this, they lost north of 98% of their revenue. I mean, can you imagine trying to run a business with fixed costs, fixed real estate costs, and losing 98% of your revenue in the span of 2 weeks? It's kind of mind-blowing. So the reaction was probably an overreaction. We haven't really done much to solve the public health issue yet. We haven't actually taken a bite back out of the virus, but we are learning to cope. Those are two different things, but the ability to cope does allow some economic activity to resume. And because some of it is resuming, we're able to start hiring back. Now, we've hired back approximately 50% of the jobs that we've lost. And the hiring back curve about a month ago was rather steep, heading right back towards our baseline. However, in the last month, it's really plateaued and it's flattened out. And some of this may be permanent. I mean, there are a whole host of efficiencies that have been developed because companies had to, not because they wanted to. But in developing those efficiencies, they may need fewer employees on the other side. Luckily, before this recession, we couldn't find enough workers. So, you know, how these two forces balance out on the other side of this is I think, really anybody's guess. But my guess is that we will continue to see a slowdown in the rate of recovery, and that we aren't getting back to those same employment numbers anytime soon. But once again, if we can solve for the virus and we can solve for the public health issue, then we have a much stronger shot of solving for the economy.
I'm gonna do one more from the room. So take yours, Jacob?
Sure.
Okay, so Jacob asks, I'm gonna shorten his a little bit, but he just is wondering if there's any parallels between the housing market in 2008 and 2020.
You know, they appear to be more contradicting one another than paralleling. In 2008, you know, real estate values were one of the early casualties. Things started moving downward relatively quickly. There were a lot of real estate defaults. There were a lot of significant reductions. I'll give you an example from right inside the valley. The Prospect lots up behind Mount Crested Butte. Before the recession in 2007, they were selling in the neighborhood of 1.2 to 1.4 million. In the aftermath of the recession in 2012, I saw one sell for 125,000. So when you have segments of real estate that are losing 90% of their value, it's going to inject a heck of a lot of uncertainty and probably some panic. Now compare that with today. You know, we're seeing a real estate boom in the Gunnison Valley, and we're seeing a real estate boom here in Denver. Denver just over the past 6 to 8 weeks had its steepest increase in median home values that it's ever recorded, something like 24% over a span of about 8 weeks. That's remarkable. Why? It's hard to say. You know, as a banker in the Gunnison Valley, I can tell you a lot of the folks we talk to right now have, as a function of having to work remotely, they've learned how to do it. And their companies might have downsized their office space. And, you know, I have heard many times recently, well, I figured out I could work from anywhere. And if I can work from anywhere, I think I'd like to work from the Gunnison Valley. So I'm going to build a house here, or I'm going to buy a house here. So, you know, they're headed in different directions from the two different recessions. Part of the current boom is certainly driven by interest rates. You know, the 10-year has just been bouncing and going below its all-time low. It's been sort of range bound, like 0.65 to 0.75 in that kind of range. That's ridiculously low. It leads to ridiculously low mortgages. Earlier, I told you one of the purposes of lowering rates is to artificially increase the value of interest rate sensitive assets. And that is exactly what's happening in housing markets right now. When a lot of people look at what kind of house they can afford, they ask themselves what kind of monthly payment they can afford. Well, monthly payment is a function of two things, both the interest rate and the size of the loan. So in these very low interest rate environments, it's easy for home prices to get out of hand. And one of the things we may inadvertently be doing right now with this protracted period of long rates is building asset bubbles, specifically in real estate markets. So this could be our next dragon to slay. We'll see.
You want to take a Zoomy?
Yeah. So I'm going to kind of blend two questions together. that were asked through Zoom. Kyle asked, with the Fed using almost all the tools they have in order to help improve and stabilize the economy, with COVID, what else can they do? And then another question asked by Brian, with the federal debt adding up to over 100% of our GDP for the first time since World War II, alongside record stock buybacks fueling our prior bull market, is the Fed willing to completely disconnect the stock market more than it already has from the economy with even more QE? And he said, why not let poorly managed companies fail rather than getting bailed out through the Fed's numerous credit facilities?
Okay, first of all, that's not 2 questions. That's like 8 questions. But I will do my best.
Yes.
And I'll take the ones I remember first, and then you can remind me of the other ones. So with respect to our total debt eclipsing GDP for the first time, that is of concern. You know, the adage is that you do not deficit spend when times are good so that you can keep your powder dry and deficit spend when you need to. GDP, as I'm sure most of you know, is a 4-legged stool. We've got net import-export, we've got business spending, we've got government spending, we've got consumer spending, which makes up about 70% of it. When you have to artificially prop up GDP during tough times, you need to have that government spending leg of the stool, that tool available to you. And if you've spent all your government spending and run up your deficits when you didn't need it during good times, you don't have a lot of margin to run it up during bad times. I don't fault the current stimulus work, and it will result in large amounts of debt, but it's absolutely necessary right now. We would be in such worse shape right now if we didn't have the first rounds of stimulus, and we'll be in even more bad shape if we don't have some additional rounds. But the mistake was made over the past several years by deficit spending when we didn't need to be deficit spending. That's the piece we should have done differently, and unfortunately it's too late to do that differently today, but perhaps we can learn from it. Now, the most recent number I've seen is 107% of GDP. That is recoverable. That is perhaps getting uncomfortable for some. I'm one of them, but it is certainly recoverable, especially when we're able to issue debt at the kind of rates we're able to issue debt at right now. So by managing this debt well and managing into the future, we can recover from it. That is not to say that it's not of concern. Okay, what were some of the other questions in that laundry list?
That pretty much covered it, other than why not let, or is the Fed willing to completely disconnect the market to let poorly managed companies fail rather than getting bailed out?
Okay. So tons of companies will fail. Tons of companies failed in the last recession, and tons of companies are going to fail in this recession. And it is part of our economic process that companies that are not run well enough, do not plan well enough, essentially get flushed when things get tough enough. And that happened last time. It's going to happen this time. And you know, a lot of those companies will not be saved by these programs. The companies that I believe, and lots of folks believe, are worth bailing out are the ones that I touched on earlier, that are systemically important, that would cause, what if because we didn't bail out company X, you're going to lose your home? That's not fair. It's not fair to you as a citizen. So we try to find those systemically important companies and protect them. Now, once again, like my last answer, I'm going to go behind that and give you my wishful thinking, which is we shouldn't have allowed them to become that systemically important to begin with. That's back to the too big to fail. But we did, and here we are. So it's not worth letting some of these companies fail. Some of them need to be protected, but plenty of other ones will fail. Now onto the stock market, equities. I believe that equities are a sideshow and that they get way too much attention. The Dow and Wall Street is not the economy. It is the trading of equity positions, which is really trading oftentimes a speculative future value on what you think this company might produce and what it might be worth down the road. That's not the economy. That's not selling widgets. That's not manufacturing widgets. That's not running trading desks. It's a completely separate beast, and it gets way too much attention, and it's not the indicator that it wishes it was.
So do you think it's a good time to invest?
Yes and no. How's that for an answer?
So I'm gonna jump in and then we can go back to some of the other ones on there. This is from Michael Grabowski, which I don't. But let me. So this is going back to something you said earlier, which about the removing the politics from the Federal Reserve on there. But Michael asks, do you think that future presidents will attempt to persuade the Federal Reserve to set interest rate levels at certain levels, like our current president is attempting to do? So, what do you think is that's happened a lot in the past too. So, what do you think is the future of that? Do you see that as increasing pressure on the Federal Reserve on that one?
There was a lot of pushback from the Federal Reserve to some of the more egregious direct requests for interest rate reductions or other accommodative monetary policy. I would hope that the American public pushes back on that in the future, and that they elect folks to that office that don't think they should interfere with the independence of the Fed. The Fed can't operate if it's a political football. We cannot run monetary policy like that. Monetary policy has a long-term outlook. It doesn't run on election cycles. I don't think I'm really directly answering your question very well, but it's because I don't know.
Yeah, I understand. Yeah.
But I hope we see through this. I hope our electorate sees through it. I hope we make rational decisions about future leaders that don't want to interrupt a system that has served us really well for a very long time.
Can I ask it slightly differently? And just as a follow-up, what do you think monetary policy would look like if it were run by either Congress or under presidential edict?
Well, every time we had an election cycle, you would likely see a rather predictable reduction in interest rates because consumers like that. People would start to plan around these types of reductions. Our artificial cyclical behavior that we would tend to set up at that point would drive markets and drive decisions. And then if they didn't follow through in the ways markets expected, there'd be disaster. You would have a wildly volatile economy, switching back and forth between administrations, where you might have very different views about how to operate the economy. We get that today, but the administration and Congress doesn't have their finger on the lever of monetary policy. That's the piece that's been separated. So by maintaining that separation, the economy doesn't feel the full volatility of politics in America. And if we allow that connection to be remade, we will be subject to that type of volatility, which is really, if you go back to our dual mandate, price stability and full employment. These are things that in an ideal world lack volatility. So why would we intentionally insert volatility into our system?
You want to do another one?
Yeah. Well, you talked about it a little bit on how the first stimulus, kept us out of a hole that we might not have been able to dig out of. But what effect, positively and negatively, could the government stimulus have for the market and also for just consumers, as another one possibly is coming out?
Yeah, it's hard to separate those two in my mind. So we bank, especially here in Denver, we bank some fairly large landlords. They own multiple properties. Where would those guys be, and where would that component of this housing market be if their tenants couldn't pay the rent? Well, lots of them lost tenants, and lost quite a few tenants. And lots of them had tenants stay that would not have otherwise been able to pay the rent, except they received a stimulus check. You know, when we touched on GDP a moment ago, I referenced the fact that it's about 70% consumer spending. What if a good chunk of that consumer base can no longer spend? You run pretty rapidly into that being a major component of GDP and the economy as a whole. So hard to separate. You know, the early stimulus, the stimulus checks were designed at the very entry level of our economy, consumer, and likely the consumer that works somewhere in a service industry. You know, things like the PPP loan program, which we did at Gunnison Bank and Trust, we injected about $14 million into the Valley through PPP loans. These are largely going to be forgiven. They did come with a lot of caveats. The main one is that most of that money has to be spent on payroll. So if you've got a friend that is a RAF guide or a server or a construction worker or any number of things that were to varying degrees interrupted by all of this, they still got paid. And so the wheels kept turning here at the base level. They could still order a pizza from Mario's. They could still go out and spend to some degree because they were receiving pay from their employer, who was receiving a forgivable loan directly from Gunnison Bank, but paid for by the SBA.
So why don't we take two more questions, one on there, and then Dylan, you want to add a question?
Yeah, I do.
You must be getting tired, so I think we'll do two more questions, just so you're not.
All right, so my question was, at the beginning of the pandemic, a lot of the job losses that we saw were seen as rather temporary, and that they would come back right as we came up with a vaccine or whenever this was solved. But as some businesses find that online is a viable option, do you think that we're going to see some permanent job losses that aren't going to come back no matter how the pandemic is solved?
Did you get that?
Yeah, I did. Thank you. And the answer is yes, I think we are. And I referenced a graph. I wish I had it at my fingertips. I would show it to you. But rather quickly, over a period of just a couple of months, we gained back about half the jobs we lost. But that line, that steep recovery line, is plateauing and tailing off now. And as I touched on earlier, I think that's from efficiencies that businesses were forced to take on. I'll give you a quick example from 2016. In 2016, oil production, domestic oil production, was at an all-time high, and then the bottom essentially fell out of the price of oil. And so as oil prices were declining rapidly, they had been up around, they'd been well over $100 a barrel, but they'd been in the $120 a barrel range. And at this time, the break-even price for West Texas Intermediate was about $70 a barrel. Well, as oil continued to fall and fell well below $70 a barrel, rigs started getting shut down. And as rigs started getting shut down, oil workers were losing their jobs. And so there was this massive renegotiation process that went all the way through the industry. There were rigs negotiating with landowners. There were operators negotiating with their unions and all their employees. And essentially, the entire supply chain for oil was renegotiated. Coming out the other end, the break-even price of oil dropped down to about $42 a barrel for the rig owners. So instead of shutting down rigs now, they continued to keep them open. So it was kind of a win-win throughout the economy, but it did result in needing fewer oil worker rigs because there were fewer rigs by the end of this than how it started. So I think we might be seeing that same kind of scenario play out on a much larger stage here, in that, yeah, some jobs are coming back, some are necessary. If you order a beer, someone has to bring it to you. That is unlikely to change. So actually, I can think of how that would change. Now there's those self-serve tap bars where you go and you can just. I'm digressing. I must be getting thirsty. You know, a lot of it will come back quickly and a lot of it has, but you're right. A lot of it will tail off. Efficiencies are embedded in these organizations and industries now, and they're unlikely to go away. The only way probably to get employment numbers back where they were is sufficient growth.
So does anybody in the room have another question? I have one that I want to ask at the end, but I want to make sure that you've got one. All right, go ahead.
What is the effect of issuing those forgivable loans on the real interest rate to Gunnison Bank?
Did you get that?
Yeah.
Okay.
I don't know where to start on this question because I've been over 20 minutes, so I'll try to be succinct. We were asked to commit by the SBA very early in this process, and you know, there were some in the couple of weeks following all of this breaking. I was on conference calls with Cory Gardner, other folks from his office, other senators, trying to piece together this plan for this project. How are we going to build something that gets out there quickly, something that we can get to all the right targets, and something that doesn't have a long-term painful effect to all the folks that we're trying to help. And so we started building this thing, and we started committing to doing PPP lending before the CARES Act had even passed. Then we were surprised by some components in the CARES Act, which weren't how we had structured it up front. You know, my work with a couple of senators and lobbyists got the thing out there, but then, you know, then all the doors shut and all the behind the scenes work took over, and we just kind of got to see at that point the end product. Well, another banker friend of mine described it as building a car while you're driving it at 90 miles an hour. And that is what it felt like. And everybody kept saying to us, oh, just get the money out there. Just get it out there. It'll be fine. And I'm like, hey, this is Gunnison Bank's $14 million we're talking about here. We'd love to get it out there, but I need just a little bit more information about how we get it back, because it's relatively important to us. So there were a lot of leaps of faith made, and you know, our bank being chartered. Oh, by the way, we're the only bank chartered in Gunnison. Gunnison Savings and Loan as an SML is chartered there, but all the other banks in Gunnison are chartered somewhere else, and their location in Gunnison is just a dot on a map to them. Gunnison is who we are. It's where our charter started in 1910, and we feel a very deep sense of commitment, not just to the community, but to all the businesses in it. So we were in it from the beginning, and it was scary. It was getting built while we put it together. And here's the worst part: it still hasn't been resolved. We still don't know what the forgiveness plan is. So right now, all these loans are out there. We've got $14 million in loans out to the Valley's businesses. They are earning at 1%. So, you know, your question about how does it affect our portfolio rate, it brings it down pretty significantly. But we still don't know what the forgiveness program is. You know, there have been 7 final interim rules. Now, ask yourself, what does a final interim rule mean? I can't even wrap my head around that language. It doesn't mean anything. Anyway, there's been 7 of them that have come out of the SBA about how we're actually going to get the forgiveness check from the SBA for all this lending. So we did it. I'm glad we did it. I know most of the other banks did it too. I think they're all glad they did it. It has hurt us from a net interest margin perspective. It was definitely the right thing to do. It did save a lot of businesses in our valley and across the country. And hopefully we will have a reasonable resolution to it that it doesn't sting too much for the bankers that went out there and tried to do the right thing with a lot of uncertainty.
So I have one last sort of quick question. I don't know if it's quick, but I'll try. So we have a lot of budding ski bums who want to eventually be really successful in here. What advice do you have?
So, you know, you guys came to Western because it's a great school and it's in a great spot. And Western's one of those schools that you get back what you put in. If your mission is to skate through 4 to 6 years of undergraduate and just have a good time, I know some of my friends who went to Western who were able to pull that off. But if your mission is to really come out of Western with solid education and a good understanding, you can get that too. The smaller class sizes, interactive things like this. Back in 1991, I took a class from Pete Klingsmith, who was Phil Klingsmith's father. He's no longer with us. He taught a graduate level class in the summer on water law. We met 5 days a week, 8 hours a day for 6 weeks. We covered the entire body of Colorado water law. And as it turns out, Pete had either written opinions or litigated about 75% of the cases. You're not going to find that kind of opportunity everywhere. So dig in and take advantage of what a small school in a great location can offer you, number one. Number two, be an opportunist. Number three, ski a lot. Ski your ass off. This is the most skiing you'll get to do.
Luis, do you want to close it out, or?
You can close it out. I just.
Thank you, guys. That was terrific, by the way. I really appreciate it.
Thank you, guys.
I am gonna interject one thing. So I talked to Ashley earlier and said, if any student wanted to talk to you a little bit further, could I facilitate that? And he said, absolutely. So if anybody would like to talk to Ashley further, I know not every question got asked, send an email to me and I'll set up a schedule. I had told him about 15 minutes or whatever. As you can see, it might go longer than that. So anyway, but we just appreciate him coming and doing this. I also want to say thank you to Joel Watson. He is our marketing professor. Without Joel, he's our IT guy, and he comes every week. He comes every week for this. So, and of course, for Tyler, and I'm going to let Dave close this out with Ashley, but this was just really informative and just awesome. So thank you for that. And
I just want to thank you for your time, Ashley. This is great, and I think the students got a lot out of it, and just great to hear you on this. Great to hear a Western graduate doing so well out there. So that is all great for us. Thanks for coming.
Awesome. Thank you.
Oh, thank you. Thank you, guys. Thoroughly enjoyed it.
Thank you again, and I'll be in touch.
Okay, sounds good. Thanks, everybody. Thanks for your questions.